In March 2023, something unusual happened, something almost invisible to the nightly news cycle, but loud enough to send a tremor through the global gold markets. Standing inside the gilded halls of Mar-a-Lago, Donald Trump said a line that felt like it had been pulled straight from another century. "We used to have a thing called the gold standard. It was beautiful. Real money. Now we have paper backed by nothing. That will change." Most people moved on. Most analysts shrugged. But those who study monetary history know that presidents do not casually invoke the gold standard, especially not in a room full of donors, former officials, and financiers who understand exactly what such a statement signals. Then came July 2024, Iowa, a campaign stage. Trump leaned into the microphone and said, "On day one, I will restore sound money to America. The dollar will be strong again, backed by something real." Commentators dismissed it as theater, another applause line crafted for a restless crowd. But Trump doesn't speak about monetary architecture by accident. And it becomes even more interesting when you examine the people orbiting him. Judy Shelton, a longtime critic of fiat money, famous for arguing that gold-backed currency is essential for national stability. Robert Lighthizer, obsessed with rebalancing the US-China relationship, convinced the current system gives Beijing a structural advantage. Steve Bannon, pushing economic nationalism and advocating a return to sound money as a foundation for sovereignty. Put these names in a line, and the pattern stops being subtle. Trump isn't playing with metaphors. He's preparing to do something no U.S. president has attempted in nearly a century: reintroduce a gold-backed dollar. And the timeline is not random. The target is 2027 a year, chosen not for politics, but for mathematics, geopolitics, and the rhythm of historical cycles. Because a gold reset is not an economic reform. It is a controlled detonation, a deliberate collapse and rebuild mechanism that transfers wealth on a scale so massive it can't be fully absorbed in one sitting. Gold would be revalued 10 or even 20 times higher. Trillions in debt would dissolve in a single mathematical stroke, and global power would migrate violently from those who hold paper claims to those who hold physical metal. The justification will not be framed as ideology, but as survival. China and the BRICS nations are preparing their own gold-backed currency. They are increasing gold reserves at a speed we haven't seen since the 1,960 seconds. They are building parallel payment systems, SIPs instead of SWIFT, yuan for oil contracts, BRICS credit arrangements. From Trump's perspective, waiting means surrender. Acting first means controlling the tempo. It is preemptive financial warfare. Go back to gold before China does. To understand why Trump might truly pursue this, we must look backwards. Currency resets are not anomalies. They are the heartbeat of modern civilization, occurring every 50 to 100 years, whenever debts accumulate beyond the capacity of honest repayment. The last major reset was 1971, when Nixon ended dollar convertibility. Before that, 1933, when Roosevelt seized private gold and revalued it. Before that, 1879, the classical gold standard era. We are now 54 years past due. But to understand the future, you must grasp the mechanism of the past. From 1879 to 1933, the United States lived under what economists call the classical gold standard. Every dollar represented something tangible, an exact weight of gold. If you held a $20 bill, you could walk into a bank and exchange it for a full ounce of gold at a fixed rate of $20.67. This system, rigid as steel, prevented the government from printing beyond its means. Dollars could not multiply unless gold reserves multiplied. Inflation remained chained, and deficit spending was forced to obey arithmetic. Then the Great Depression hit. Banks failed. Unemployment exploded. Credit channels froze into ice. Roosevelt needed liquidity fast, but the gold standard acted like a locked door. So on the 5th of April 1933, he shattered that door with Executive Order 6102. Overnight, private gold ownership became illegal. Citizens were required under threat of prison to surrender their coins and bullion at $20.67 per ounce. It was the most aggressive monetary intervention in American history. People lined up at banks, turning in the metal that had safeguarded families for generations. And then the real shock came. In 1934, after the government had collected the people's gold, Roosevelt revalued it to $35 per ounce, a 69% overnight devaluation of the dollar. Wealth was transferred from citizens to the state in a single stroke, $3 billion worth in 1,930 seconds money. This allowed the government to expand the money supply, inflate the economy, and restart the engine of national recovery. Brutal, yes. Effective, also yes. That pattern confiscate, revalue, reset became the template for all future monetary transformations. Then came Bretton Woods, 1944. The dollar became the anchor of a new world order, backed by gold at $35 per ounce, but only for foreign governments, not for Americans. And for a while, it worked. The world boomed. Trade flourished. But the U.S. printed more dollars than its gold stocks could justify. The math failed long before the politics did. By 1971, foreign governments held $70 billion in dollar claims, while the U.S. vaults held only $10 billion in gold. Other nations, especially France, realized the imbalance. Charles de Gaulle famously dispatched a warship to New York to collect France's gold. Others followed. Fort Knox drained like a leak in a submarine. On the 15th of August, 1971, Nixon closed the gold window. The dollar became a pure fiat currency, backed by nothing but trust. Over the next half-century, the money supply exploded more than 0%, and the dollar lost 98% of its purchasing power. What cost $1 in 1970? One cost $7, $8, $100 today. But contrary to popular belief, the gold standard did not collapse. It was killed. It worked too well. It blocked politicians from funding wars, social programs, and geopolitical ambitions with unlimited credit. By removing gold, Washington gained the freedom to borrow, spend, and inflate without restraint. 54 years later, that freedom has reached its mathematical limit. The global monetary system is straining. The pillars holding the dollar's dominance reserve status, petrodollar flows, and U.S. military influence are showing cracks. Countries are diversifying away from treasuries. Central banks are buying gold at the fastest pace since the early 70s. Russia, China, Turkey, India, Singapore. They are not acting on theory, they are acting on pattern recognition. And Trump, whether by calculation or instinct, sees the moment approaching. A return to gold, executed strategically, could solve multiple problems at once. Restore confidence, preempt China, reduce real debt, and re-anchor American power. The only question is how and when. And the answer, increasingly, points to 2027. To understand why the year 2027 stands out so sharply, you have to examine the fractures forming underneath the global monetary order. The dollar's dominance has always rested on three intertwined pillars: its role as the world's reserve currency, its monopoly over oil pricing, and the projection of U.S. military power. For decades, these pillars worked together like gears in a vast machine. But now, each one is grinding, slipping, and cracking. The dollar's share of global reserves has fallen from 71% in the year 2000 to 58% in 2024. That is not drift, it is erosion. Countries watched what happened in 2022 when the United States froze $300 billion in Russian central bank reserves. Whether one agrees with the decision or not, the message to the world was unmistakable. Dollar reserves are not neutral. They are permission-based assets that can be taken away. When money becomes political, nations seek alternatives. That's why the petrodollar system, the arrangement that forced the world to buy oil in dollars, has begun to dissolve. In 2023, Saudi Arabia agreed to accept yuan for Chinese oil purchases, ending a 50-year tradition. In 2024, Saudi Arabia joined BRICS. These are not symbolic gestures. They are repositioning moves in a monetary chess game that is shifting away from Washington's control. Meanwhile, America's own financial architecture is showing signs of strain. U.S. Federal debt stands at $36 trillion, more than 120% of GDP. Interest payments alone are nearing $1.2 trillion per year, more than the entire defense budget. The government is borrowing money just to pay interest on previous borrowing. Economists call this the death spiral of sovereign finance. And the traditional escape mechanism printing money comes with consequences. It weakens trust, it accelerates foreign diversification, it speeds up the timeline of a reset. Central banks have noticed. They are accumulating gold faster than at any point since the early 1970s, right before Nixon ended convertibility. In 2022, they bought more than 1,100 tons of gold. In 2023, another surge. By 2024, cumulative purchases exceeded 3,000 tons in just 3 years. China, Russia, Turkey, India, Poland, Singapore, they are all shifting their reserves from paper promises to physical metal. This is not diversification, it is preparation. China officially claims around 2,264 tons of gold. Unofficial estimates place the real figure between 4,000 and 6,000 tons, potentially the largest accumulation in modern history. Russia has built its reserves from 600 tons in 2010 to more than 2,300 tons today. These nations are not gambling. They are executing a strategy. A gold-backed BRICS currency has been discussed openly. The pieces are being placed on the board. Trump and his advisors know the implications. If China, Russia, and the BRICS bloc launch a gold-backed alternative to the dollar, global trade flows could shift away from the U.S. in a matter of years. For a nation that relies on debt-financed spending and global credit demand for treasuries, this would be an existential threat. Thus, returning to gold is not a nostalgic idea, it is a strategic counterattack. But how would Trump actually execute such a dramatic transformation? There is a historical template. Roosevelt used it in 1933, Nixon used elements of it in 1971. The process unfolds like a sequence of controlled detonations. The first step is declaring a national emergency. A president cannot simply announce a return to the gold standard. He needs extraordinary authority. Fortunately for any administration, that authority already exists within laws like the Trading with the Enemy Act of 1917, the International Emergency Economic Powers Act of 1977, and the National Emergencies Act of 1976. Roosevelt used these to justify seizure of private gold. Trump could use them to justify restrictions or revaluation. And because he would frame the crisis as a threat from China and BRICS, and economic Pearl Harbor opponents would be cast not as dissenters, but as people weakening America during wartime conditions. The second step is gold restriction or confiscation. Trump may not replicate Roosevelt's extreme version, but the logic pushes in the same direction. To back a currency with gold, the government needs gold. The United States officially holds around 8,133 tons worth around $520 billion at current prices. But the U.S. money supply is more than $21 trillion. The gap is enormous. Either more gold must be acquired, or the value of existing gold must be multiplied. Restricting private ownership makes accumulation faster. A cap, perhaps 5 ounces per citizen, would allow the government to retrieve large quantities quickly, exchanging them for dollars at the pre-reset price. The third step is the heart of the operation, revaluation. After consolidation, the government announces a new official price of gold, not $2,000. Something like $10,000 or even $20,000 per ounce. This instantly increases the value of the government's gold holdings by trillions of dollars, giving it enough collateral to back a portion of the money supply. And just like in 1934, this revaluation doesn't happen slowly. It is instantaneous, a single announcement that shifts trillions overnight. It is the largest wealth transfer mechanism ever devised by governments. Gold holders gain, dollar holders lose. The fourth step is debt restructuring. The United States owes $36 trillion. Politically, legally, economically, this is unpayable in honest money. But if the dollar is devalued by 80–90%, the real burden collapses. The government still pays back creditors nominally, but the dollars it returns are worth a fraction of what they were. It is default without saying the word default. It is what every heavily indebted empire has done across history, from Rome to Weimar, Germany to Britain in the mid-20th century. Inflation is the silent tax that erases impossible promises. The fifth and final step is relaunching the gold-backed dollar Bretton Woods II. Citizens likely would not be able to redeem dollars for gold, just as they couldn't under Bretton Woods. But foreign governments might under strict conditions. The backing restores confidence. The restrictions preserve control. The symbolism rebuilds trust in a world preparing to abandon the dollar. All 5 steps could unfold within 12 months. Emergency declared. Gold restricted. Banks closed for a holiday. Gold revalued. Debt silently reduced. Dollar relaunched. By the end of 2027, the U.S. monetary system could be fundamentally transformed and the world with it. And the timing aligns perfectly with political reality. Trump's second term would run from 2025 to 2029. Historically, presidents take their boldest, most destabilizing actions in their second or third year when political capital peaks and re-election pressure disappears. That puts the reset squarely in 2027, at the midpoint of power. But the geopolitical clock is ticking too. BRICS is planning its own currency launch by 2025 or 2026. If the U.S. wants to preempt that challenge to seize back the narrative of sound money, the window is narrow. Whoever acts first controls the next century. This is why the pattern points to 2027, because history is repeating on schedule, and the world is moving into position for a monetary collision that has been building for half a century. To see who wins and who loses in a reset like this, you must first understand the underlying physics of a gold revaluation. Gold is not just a metal. Throughout history, it has been a mirror reflecting the strength or weakness of every currency built atop it. When governments break the link between money and metal, inflation follows like a shadow. When governments restore the link, they do so at a higher gold price because the new price must account for all the inflation that occurred while the link was broken. That is why a revaluation isn't merely a financial event, it's a confession. It acknowledges that decades of debt, war spending, welfare expansion, and political excess have outgrown the old monetary structure. The system needs a new anchor because the old one has snapped. In a 2027 reset, that anchor becomes gold. And instantly, the divide between winners and losers becomes brutally clear. The winners are those who hold hard assets, especially gold before the announcement. The losers are those who hold claims on future dollars: cash, bonds, pensions, insurance promises, retirement accounts. These instruments rely on the dollar staying strong. A devaluation of 80–90% would slice through them like a blade. Let's start with the winners. Anyone holding physical gold before the reset sees their wealth multiply the moment gold is revalued. If gold jumps from $2,000 to $10,000 or $20,000 per ounce, an ounce purchased years earlier becomes a fortune. This is exactly what happened after 1934 people who secretly hid gold, defying Executive Order 6102, became some of the wealthiest citizens by the end of the decade. When the government revalued gold from $20.67 to $35, those who kept their metal illegally experienced a 69% wealth jump overnight. The same logic applies today, but with scale magnified by global debt. Gold mining companies become winners too. A mine holding millions of ounces in the ground has essentially a treasure chest waiting to be unlocked. If the official value of each ounce jumps tenfold, the company's book value explodes. Stocks of major miners like Barrick Gold, Newmont Corporation, or royalty companies like Franco-Nevada could see multi-X gains. And unlike gold coins in a drawer, mining deposits cannot be confiscated easily. They lie under mountains, across borders, owned by multinational firms. Countries with large gold reserves become geopolitical winners. Russia's 2,300 plus tons of gold transform from $150 billion in value to more than $1.5 trillion at a $20,000 per ounce price. China's hidden reserves, believed by analysts to exceed 5,000 tons, would rise from roughly $320 billion to $3.2 trillion. Suddenly, these nations have collateral, leverage, financial sovereignty. The gold revaluation becomes a global realignment of power. Hard asset owners also win: real estate, farmland, productive businesses. These assets maintain their intrinsic value even as the dollar collapses, and fixed-rate mortgages become gifts. If you owe $300,000 on a house and the dollar loses 90% of its purchasing power, the real burden of your debt falls to what amounts to $30,000 in pre-reset value. The house, meanwhile, resets to a new nominal price, perhaps $5 million instead of $500,000. You escape your debt while keeping your asset. This is how generational wealth flips, not through effort but through monetary transformation. But where winners rise, losers fall. And in a reset, the losers are the backbone of the middle-class financial structure. Dollar holders are crushed first. Cash in bank accounts loses 80–90% of its purchasing power. A family with $100,000 saved for a home suddenly has the equivalent of $10,000 in real value. Treasury bondholders are next. They lent money to the government expecting safe returns, but the dollars they receive back are worth a fraction of what they were. U.S. Treasuries, the bedrock of pension funds, insurance portfolios, and retirement plans implode in real terms. Foreign creditors suffer catastrophically. China holds around $800 billion in treasuries. Japan holds more than $1.1 trillion. If the dollar is devalued, these nations lose nearly everything in real purchasing power. They will be paid in dollars that are numerically the same but economically hollow. It is default disguised as policy, and because it does not violate the legal form of repayment, the United States avoids the stigma of true default while achieving the same outcome. Pension funds and insurance companies may be the hardest hit. Much of their capital is tied up in long-duration bonds, assets that become nearly worthless under a revaluation regime. Retirees expecting $40,000 or $50,000 per year suddenly have incomes equivalent to $4,000 or $5,000 in purchasing power. The elderly cannot re-enter the workforce. They cannot rebuild. The pain is permanent. And then there is the middle class, the group that is always squeezed hardest during monetary resets. Most of the middle class does not own gold. They own dollars, savings accounts, 401k, plans filled with bonds, and perhaps a modest home. They believe in linear progress, steady work, retirement planning, predictable growth. A reset annihilates that world. Their savings evaporate. Their debt-heavy assets reprice. They are left with what economic historians call paper illusions, numbers that look the same but mean almost nothing. This hollowing out effect creates what many economists call neo-feudalism, a society divided between asset owners and asset renters, between those who saw the reset coming and those who trusted the system to protect them, between people with metal and people with paper. But the monetary shift is only the first half of the equation. The geopolitical consequences could be even more profound. Trump's return to a gold-backed dollar would not happen in a vacuum. It would occur in direct confrontation with China's long-term strategy to dethrone the dollar. Since 2008, Beijing has constructed alternative structures: the Asian Infrastructure Investment Bank, the Belt and Road Initiative, and its own interbank payment network, KIPS. China has signed oil and gas agreements settled in yuan with Russia, Saudi Arabia, and other nations. And it has been accumulating gold at a pace unmatched in modern history. BRICS expansion in 2023 to include Saudi Arabia, the UAE, Iran, Egypt, and Ethiopia was a geopolitical earthquake. Together, BRICS now encompasses nearly half the global population and more than a third of global GDP. Their discussions of a gold or commodity-backed currency are not academic. They represent a coordinated plan to reduce dependence on the US dollar, weaken America's ability to print its way out of debt, and shift global trade toward a multipolar system. Trump's potential gold reset is a counterstrike. If he moves first, he puts China on defense. A gold-backed dollar regains the moral high ground. Trust our currency, not theirs. Oil producers might stay aligned with Washington. Smaller nations might choose the American system over the BRICS alternative. It would be a monetary arms race, and the first mover would shape the next century. But there is a darker possibility, a scenario whispered among historians of Bretton Woods and Nixon's shock. What if the return to gold is a strategic trap? The U.S. could reintroduce a gold-backed dollar in 2027, lure the world back into holding dollars, rebuild global dependence, and then, once trust is restored, suspend gold convertibility again, just like Nixon did in 1971. Gold backing would serve as bait, dollar dominance would return, and China, Russia, and the BRICS nations would find themselves cornered once more. It would be the most audacious monetary play in American history. China understands this possibility. Russia understands it. That's why they are building their own systems parallel, insulated, de-dollarized. And that is why the world is slowly dividing into two monetary blocks: the dollar zone and the BRICS zone. A new Cold War, but fought with currencies instead of missiles. Now imagine the timeline of how all of this unfolds, not as a theoretical model, but as a sequence of political, economic, and psychological events stretching from 2025 to 2027. These kinds of resets never arrive suddenly. They build like a storm far offshore, visible only to those who study the clouds. Then, one day, the coastline begins to tremble. The year 2025 begins with Trump returning to the Oval Office. The first months of any presidency are chaotic appointments, confirmations, political battles, cabinet reshuffles. But beneath the public noise, something quieter happens. Trump's economic team begins preparing legal frameworks, analyzing gold supply chains, studying historical precedents, drafting emergency policies, and building alliances inside Treasury and the Federal Reserve. Nothing is announced. Nothing leaks. Markets remain calm because calm is part of the strategy. A reset only works when the majority of investors and citizens remain unsuspecting until the moment of execution. By mid-2025, global pressures intensify. The U.S. deficit widens. BRICS finalizes infrastructure for its alternative currency. Oil producers continue drifting away from the petrodollar. American bond markets experience periodic tremors, yields spiking, then falling, then spiking again. The Federal Reserve quietly intervenes, absorbing freshly issued treasuries, printing money at a pace the public does not fully grasp. Inflation becomes sticky. Confidence begins to evaporate. In 2026, the crisis becomes visible. Federal debt crosses $40 trillion. Interest payments approach $1.5 trillion, forcing the government to borrow simply to stay afloat. BRICS announces the official launch date of its new commodity-backed currency somewhere in late 2026 or early 2027. Several oil nations, Nigeria, UAE, Qatar, announce they will accept BRICS currency for energy exports. This is the moment American policymakers dread. The monopoly on pricing global oil in dollars begins to fracture. Treasury yields surge again. The Federal Reserve must choose between letting the bond market implode or printing money to stabilize it. Historically, central banks always choose to print. Printing accelerates inflation, and inflation accelerates political fear. By late 2026, the stage is set. The US faces a dilemma that every empire eventually faces: defend the currency or defend the debt. Defending both becomes impossible. This is when Trump acts. Late 2026 or early 2027, the White House delivers a prime-time address. The tone is severe. The language is surgical. Trump announces a national economic emergency, citing China and BRICS as threats to American stability. He frames the crisis as a geopolitical attack. China is launching a gold-backed currency to destroy the dollar. We must act first. This framing reshapes the narrative instantly. Political opposition becomes unpatriotic. The public perceives a foreign threat, not a domestic policy failure. Fear turns into support. He signs an executive order restricting gold ownership. The government places temporary controls on gold trading. Banks close for a one-week bank holiday similar to Roosevelt's bank closure in 1933. ATMs limit withdrawals. Markets panic. Gold spikes 50% in days. The government freezes the spike by suspending trading. The public, confused and frightened, waits for clarity. Then comes the reveal. By mid-2027, banks reopen under new rules. The Treasury announces that the United States has officially restored a gold-backed dollar. The conversion price is set at something between $15,000 and $20,000 per ounce. Citizens may own up to 5 ounces. Anything beyond that must be sold to the government at the pre-revaluation price. A 90-day compliance window is announced. Penalties for non-compliance mirror those of 1,933, fines, asset seizure, and potentially criminal charges. This moment is the reset. Gold holders who surrender their metal early receive modest gains. Those who hold foreign gold or concealed gold, if they escape detection, become extraordinarily wealthy overnight. The dollar devalues sharply, but stabilizes because it is now backed by something real. International trade resumes. Some nations accept the new dollar. Others reject it and pivot entirely to BRICS. The world splits. 2 monetary zones emerge. 2 systems. 2 centers of gravity. A new Cold War, but fought with ledgers, not armies. Inflation surges in the U.S. during the transition. Prices adjust to the new currency regime. Protests erupt. Some cities experience unrest. But slowly, over months rather than weeks, the economy stabilizes. The debt, in real terms, has been erased. Government balance sheets look stronger. The new dollar gains global attention. And America, while bruised, resets itself leaner, meaner, financially reborn at the expense of creditors and unsuspecting savers. And the question becomes, what do ordinary people do? How does one position for an event that only happens once every half-century? Historical precedent offers clues. The first strategy is timeless: physical gold. But not just owning it, hiding it. In 1933, the Americans who gained the most were those who kept their gold out of sight. The government compensated surrendered gold at the old price, while hidden gold appreciated at the new, higher price. It was illegal, risky, but astronomically profitable. The second strategy is buying gold abroad. Gold stored in Switzerland, Singapore, or other jurisdictions with strong property protection cannot be confiscated by U.S. executive order. In the 20th century, wealthy families safeguarded fortunes by moving metal offshore. In a 2027 reset, the same dynamics apply. Foreign gold remains untouchable. The third strategy is gold mining stocks. They escape confiscation but benefit from revaluation. A mine with 3 million ounces in the ground suddenly has reserves worth 10 to 20 times more. Stock prices detonate upward, and foreign miners, Canadian, Australian, African, remain outside the reach of U.S. nationalization. The fourth strategy is borrowing in dollars to buy real assets. This has been the secret weapon of the wealthy for centuries. If the dollar collapses, your fixed-rate debt collapses with it. A $500,000 mortgage becomes trivial. Meanwhile, your house, farmland, or business rises in nominal value. You destroy your debt while keeping your assets. The fifth strategy is holding foreign currencies: Swiss francs, Singapore dollars, Norwegian krone, and foreign real estate. These buffers protect against domestic devaluation. And the sixth strategy is ancient but reliable: survival reserves. In every currency reset, supply chains wobble, banks close, ATMs fail, prices fluctuate violently. For weeks, or even months, life becomes harder. Food, water, medicine, fuel, these become priceless during transitional chaos. These strategies aren't speculation. They're drawn from 1,933, 1,971, the 1,998, Russian default, Argentina, 2001, and countless currency resets across Latin America and Europe. Those who held paper suffered. Those who held real assets endured or prospered. Which brings us to the philosophical core of the 2027 reset: inevitability. Trump may be the executor, but the system itself is what demands the reset. Debt has outgrown reality. The dollar is losing trust. BRICS is rising. The clock of history is ticking. And for more than a century, resets have always occurred when the math breaks. The final act is not about Trump. It is not about China. It is not about ideology. It is about the arithmetic of empires. When debt becomes too heavy, nations do not pay it back. They transform it. Sometimes quietly, sometimes violently, but always predictably. As the reset approaches its final phase, something strange happens: clarity. Events that once seemed disconnected begin aligning like gears in a clockwork mechanism that has been turning for decades. When you step back, you see the pattern that was always there. Every empire, every currency, every debt cycle, every political transition follows the same rhythm. The United States is not the first. It will not be the last. But it may execute the most globally consequential monetary reset the world has seen since 1971. Trump's return to the gold standard, if it happens, will not be packaged as ideology. It will be sold as national salvation. The narrative writes itself: America is being financially attacked by China and BRICS. The dollar is being undermined by foreign gold-backed systems. The U.S. must restore sound money to defend itself. Emergency action is unavoidable. And when framed as national security, resistance collapses. This is how Roosevelt justified gold confiscation in 1933. This is how Nixon justified closing the gold window in 1971. This is how every major monetary shift is legitimized through fear, patriotism, and necessity. The mechanism is always the same: confiscate or restrict gold, revalue it at a higher price, devalue the currency, erase debt, relaunch the system. And because the United States is the world's financial center, the shockwaves will travel farther than ever before. Bond markets, central banks, pension systems, sovereign wealth funds, they will all feel the tremor. The consequences will reshape wealth on a scale difficult to comprehend. Gold holders will see overnight multiples. Hard asset owners will survive, even thrive. Miners will explode in value. Countries with large reserves will rise in geopolitical power. And those holding paper assets, dollars, bonds, pensions, will watch decades of savings evaporate like mist under a rising sun. But beyond winners and losers, beyond tactics and timing, the real story is philosophical. Because a reset like this forces the world to confront a truth that modern society tries desperately to avoid: money is not real. It is an agreement, a collective illusion, a temporary story we tell each other so that civilization can function. Gold, for all its flaws, is simply the oldest version of that story. Fiat currency is the newest. And every few decades, the story collapses and must be rewritten. In 1933, Americans learned this the hard way when the metal they trusted was seized by their own government. In 1971, the world learned it when the dollar detached from gold and became a promise backed only by faith. In 2027, the world may learn it again, this time through a reset that exposes the fragility of every assumption people have about their savings, their pensions, their national debt, and their future. The mathematics of debt makes the reset nearly unavoidable. The United States owes more than it can ever repay in honest money. The only viable path is to repay in devalued money. History shows this clearly. No empire in recorded history has paid its debts in full value once those debts exceeded the productive capacity of its economy. Rome clipped its coins. Britain devalued the pound repeatedly. France reset its currency dozens of times. The United States did it in 1934 and again in 1971. A new reset is not a radical break from history, it is history. And this is why 2027 fits so perfectly into the timeline. It aligns with the 50-year cycle between monetary transformations. It matches the midpoint of a second-term presidency when political consequences vanish. It intercepts the rise of the BRICS currency. It synchronizes with America's debt spiral. It mirrors the build-up to 1,929, 1,933 and 1,968, 1,971. The pattern is repeating because the conditions are repeating. By the time the public realizes what is happening, the game will already be over. Resets are not events that happen to alert populations, they happen to unprepared ones. Those who understand history will prepare not because they are paranoid, but because they recognize the rhythm: gold accumulation, foreign diversification, hard asset storage, debt repositioning. These are not speculative theories, they are the strategies used by the winners of every reset in the last 300 years. And when the reset arrives, the world will change in ways that will seem sudden but were inevitable. Banks will recalibrate, nations will realign, Trade routes will shift, inflation will roar and then fade. The dollar will shrink and then harden. Wealth will disappear and reappear in new hands. The global monetary map will redraw itself. But America will not collapse. It will adapt as it always has. The reset will hurt millions, enrich thousands, and redefine the next century. Trump may be remembered as the president who brought back the gold standard, or as the leader who triggered the greatest financial shock since Nixon, or simply as the man who accelerated a transformation that was already coming. Because, in truth, the actors do not matter nearly as much as the mathematics. The debt is too large, the trust is too fragile. The global order is too strained. The system has reached its limits, and when systems reach their limits, they reset. In the end, the reset is not a conspiracy. It is not fantasy. It is not even political. It is the recurring heartbeat of monetary civilization. The world knows it. China knows it. Trump knows it. Now, you know it. And the only real question left is, what will you do with that knowledge? Those who prepare will survive the transition. Some will become wealthy beyond imagination. Those who ignore it will face the same fate as every saver and pensioner who trusted paper during a reset. They will watch their life savings dissolve while a new system rises from the ashes. The greatest monetary transformation since 1971 is coming. The window is closing, and there is still time to prepare, just not much.